Okay, so I guess we will get started. Gail, just want to make sure that your audio is working. Just for those on the other line, our attendees, Gail's joining us from. She's part of our New York office, so just want to make sure that you are there and present, and all your tech is working.
I'm here, I'm present, and I can hear you well, and I hope that the others on the phone can hear me as well. Thanks.
Perfect. So at any point, let us know if there's any interruption with the webinar, just by using the chat there. Just so everybody knows, the webinar is going to be recorded. So tomorrow, the link for the webinar recording will be available to everybody, and we will follow up with additional resources after the webinar. So thank you for joining today's webinar. Sorry, someone just ran in and mentioned that they couldn't hear me, so just wanted to adjust my volume. So just let me know via chat if anyone has any issues hearing my voice. So my name is Luis Santiago. I'm the VP of Community here at AVG. I am joined by our senior partner, Gail Ball. Gail's been with AVG since 2017. She started here as the founding managing partner of Chestnut Street Ventures, which is one of our 20 plus funds that we have here at AVG. And my responsibilities here are fundraising operations, marketing, and community development. And so over the course of the next 25 to 30 minutes, part of the conversation, we'll really hit on four critical pieces, part of the conversation. One, we'll talk about AVG, our investment model, the select fund that is open to all accredited investors, and our fund leadership team. And so as we go through the conversation today, I just want to make sure that there's going to be three major takeaways. I think the first one will be, why might venture be right for you and your portfolio? What really distinguishes a smart portfolio, something that we work very, very hard as part of our model to achieve? And then also, how does AVG make venture investing smart and simple and accessible to millions of accredited investors out there in the US? At any given point in time during the presentation, please submit your questions. You could either use the questions feature here in the webinar, or feel free to throw your question up there on chat, and we will respond to those during the Q&A section towards the tail end of the webinar. And so with that, I'm going to welcome Gail Ball to take the reins here as our presenter for today. Gail?
Yep, thank you very much, Luis. I noticed as you were giving that introduction about yourself and about me that although we use the word alumni many times, my alumni affinity actually wasn't in my bio, so as yours was. So I thought perhaps I would just share that with those on the phone. I'm a graduate from the University of Pennsylvania from the Wharton School, which was one of the reasons why I was so thrilled to start at AVG in our core alumni fund products, running the Chestnut Street Ventures Fund for Penn alums. We're going to talk about the full product set later on, and that university affinity for our deal teams will be something that we'll dig into a little bit. But let's go to the next slide, which is digging a little bit more broadly into some of the special attributes about Alumni Ventures Group. It's a great source of pride and a great source of competency that we bring to bear for our investors when we say that we are one of the most active venture funds in the world, with well over 300 deals completed, and nearly half of those completed in just the last calendar year, 2018. PitchBook, which is one of the predominant sources for performance data for our industry, whether it's about the startup companies themselves or whether about institutional investors like Alumni Ventures Group, noted at the end of 2018 that we were we were the second most active VC in the US, behind an enterprise called Plug and Play. And I highlight that to those of you who are on the phone because Plug and Play plays, no pun intended, in a very specific space, really early in the stage of a company's formation. And Alumni Ventures Group has a different approach. Our one aspect of our characterizing our portfolio as being smart is our ability to make investments across the full stage of life cycle of private companies as they're raising capital, from very early stages to the very latest stages. And in fact, if you dig into the PitchBook statistics for 2018, AVG was the 4th most active investor in the angel and seed rounds. We were the 2nd most active investor in the early stage rounds, and we were the 6th most active investor in the late stage rounds. So really providing some further evidence of our unique ability to find deals everywhere along the spectrum of value creation for these companies, while they're private. Our mission, which both Luis alluded to and I alluded to, is about making venture capital simple and smart and accessible, and simpler and smarter than any of us could do in our individual capacities. So I've already highlighted one place where the AVG model makes it easier to get to things that are virtually impossible to get to in our individual capacity, and those are late stage deals. But it's also the case that our deal reach isn't just at the stage level, but we are also able to access deals broadly across industries and across geographies. One of the reasons for our really unparalleled access to deal flow is that our own company has grown dramatically, including the community of people engaged with us, both as investors and as community members reading our newsletters. We've grown, as it says here on the 3rd bullet, from a single fund in 2014 that in fact had 40 investors at $1.5 million, to an environment today where there are 300,000 people who read our entrepreneurship newsletters every month. There are now $300 million of assets under management, as opposed to the original first year of $1.5 million. And the last bullet, our investor pool has grown from the original 40 to over 3,000 investors. And as Luis mentioned a moment ago, we've gone from having a single product, which at that time was an alumni fund product for the Dartmouth alumni community, to 20 different funds today that operate in 2 different groups of funds that support singular alumni communities and funds that are open to any accredited investor. Luis, let's go to the next slide. So understanding that we provide a simpler and smarter access point for venture capital, you still might be asking yourself, well, why do I want to invest in venture capital? Particularly when venture capital as an asset class has seemed, rather opaque. I can't get much information about it. It's hard for me to find it. It's hard for me to find a professional advisory team like the investment teams at AVG who can help me, make sense of it. But investing in VC is an important part of diversifying any accredited investor's investment portfolio. And diversifying into venture capital brings that investor some unique benefits. VC has consistently delivered strong returns that are highlighted in that box down at the bottom left that exceed the returns that are available to us consistently in the public markets. Venture capital also does well in periods of time in which the public markets are doing less well. So as an asset class, it's only loosely correlated to the outcomes that we see in the public market, classes. In addition, companies today are able to access capital in the private markets far longer and in substantially greater measure than they have in the past. And so many companies are staying private longer, allowing value to be created and earned by the people who invested while the company was private. And some companies choose never to go public, at this point in time with markets the way they are, and the access to capital being so generous in the venture capital space. In some, individual investors who put themselves into a category of being sophisticated and leveraging their own capacity as accredited investors to access this asset class, put as much as 5% of their portfolio into venture capital. Family offices and institutions hit 15% or more of their asset allocation in venture. So in some, all of us would really benefit from an allocation to venture capital, but we really haven't had a means to do so until the products that Alumni Ventures Group has brought to bear. So let's go to the next slide, which in fact highlights that. In addition to the mystery that I really mentioned a minute ago with lack of access and lack of transparency, if you had the mechanism to access venture capital, it was hard. It was hard to get it done. You had to do your own analysis about the merits of the deals that you were lucky enough to find. Frequently, those deals would be at the very earliest and highest risk stages of capital formation, because we in our individual capacity would be relying on our local networks to find these deals. Family and friends deals, for example, a phrase that I'm certain that each of us has heard of. But the net result of these poor options for us to find venture capital in a smart way for ourselves is that, just as it says in the last bullet, the core investment thesis that we all know about the value of diversification was essentially impossible to achieve. And instead, our individual options left us with risk concentrations by stage with access to the earliest investments, risk concentrations by industry because we were using our own personal experiences and expertise to evaluate deals, and concentrated risks around geography by being subject to, again, our local networks, for sourcing deals. But now there is a series of options from the Alumni Ventures Group. So let's go to the next page where we talk about the basic terms of investing with AVG. Our venture funds are, in fact, funds. So people who invest are limited partners in the fund and who are effectively outsourcing to our professional deal teams the creation of venture portfolios. To participate, I've mentioned a few times that the regulations require, those are the SEC regulations, require that participants in our funds meet the test for being an accredited investor. And that's something I won't go through here on the phone, but we can provide as supplemental support to somebody or answer in the Q&A. To invest in any one of our funds, generally speaking, has a $50,000 minimum, which is not only enough to give you and the other limited partners in the fund you're in the firepower to build a portfolio of 20 to 25 companies that provide the diversification that we're promising, but it's also, generally speaking, very comparable to what you might otherwise have allocated to those poor direct investing options that we were just talking about, making two $25,000 investments or making five $10,000 investments, neither of which give you the diversification benefits of participating in one of the AVG funds. The funds themselves have a 10-year life. We raise capital from interested, limited partner, accredited investors for an abbreviated but fixed period of time. And then the fund is closed to incremental investment, and the deal teams or the deal algorithms begin to operate in order to deploy the capital that we've raised from our investors into a portfolio of private companies. As an investor, it's extremely simple, particularly, again, compared to that do-it-yourself option. You write one check at the outset of your engagement with the fund, and every year you receive one tax reporting document referred to as the K1, making your compliance with your own personal obligations for taxes very, very simple. As I mentioned, it's only a single capital call right at the outset of each fund that you choose to invest in. And by virtue of the diversification that we talked about in that very first slide about investing across the different stages of companies' capital raising, from the earliest stages to the latest stages, we're able to provide distributions from liquidity events in our companies faster than the industry as a whole, and directly to our investors as they're realized. Offsetting this portfolio build and the identification of extraordinary private companies across industry stages and geographies, of course, are the fees that we charge. And as are highlighted here, fees in our industry generally are expressed in these two elements and at these two price points. A 2% management fee levied for each of the 10 years of the fund's life, and a 20% carried interest for the managing partners after the fund's capital has been returned to investors and the fund is beginning to distribute profits. Wrapped all around this infrastructure and this simple structure for you as an investor is a very data-rich investor portal. And that's something else that we'll be happy to talk about more fully in the questions, and also provide in our supplemental materials. So let's go to the next page, where I've already provided some further information about what our investment model is, as I've sort of teased that in some of our earlier slides. In addition to the diversification objectives that I've mentioned a few times, AVG as an investor never leads any of the rounds that we participate in. We don't ever take majority positions in the rounds in which we're investing in. In fact, we are described as co-investors, always taking a small share alongside a leading institutional venture capital firm investor who has a documented track record and expertise in this particular company's sector or the stage at which it's operating. And we benefit both as a firm in terms of our access and for our investors by being able to piggyback on the extraordinary expertise that these top performing VCs consistently demonstrate. And we have a slide a little bit later on where we'll really, bring that particular, point home. I won't read all the bullets, for you, but you might be curious about the second bullet. Alongside our decision to always co-invest and never compete with those institutional investors. In fact, we complement the institutional investor who's leading the round that we participate in, not just by providing incremental capital to the company in their portfolio that they're trying to support, but also by directly connecting these portfolio companies to that 300,000 person community that I mentioned at the outset, looking at the scale of expertise and connection that AVG can bring to any one of these portfolio companies. So we don't ask for what would otherwise be perceived as a competing role with the lead investor. We don't ask for board seats. We don't provide, advisory roles, and we don't negotiate the terms of the round. We come in on par with other investors, and we bring our capital and our unique capacity, which is to connect our community to these portfolio companies. How and why do these lead investors, bring their deals to AVG? Well, that's another part of our, really extraordinary process. We source deals from this networked community that we have built around our core alumni venture funds. And that community consists of not only individuals who are entrepreneurs themselves and who are providing services to entrepreneurs like attorneys facilitating capital raising, but they are also our alumni colleagues, the lead investing partners in these institutional firms that we want to work with and we continue to work with in a very mutually beneficial relationship. So we're able to use our network connections in a way that others really cannot, because they don't have the same network that we've built out. In addition to that, we have extraordinary technology that we use to help our deal teams find deals, having built models that take a look at databases like PitchBook, which I mentioned earlier on, and we said, here's a model. Here's a company in this sector that raised capital at this point in time. Odds are, when we look at that particular sector and its past performance, that company is going to be raising capital 12 months from now, if in fact it's succeeding on its plan. So let's create some automated outreach to that company and get in front of them with the idea that our capital and our community could be an important value add for them. So we have great technology, great relationships, and outstanding capacity for analysis of the deals that come through these various channels. That analysis, often referred to in our industry as due diligence, is performed by our full-time investment team staff. So each of our investment team members, those who focus on deal flow, those who focus on capital raising, those who focus on these important institutional investor relationships, they're across the country where there are hubs of entrepreneurial and innovation activity present. Our offices are in New York, Boston, Chicago, and San Francisco. And in our headquarters in Manchester, New Hampshire, within our office of the Chief Investment Officer, we have additional resources that facilitate building this sizable funnel of deals for us to then evaluate, take through our diligence process, go through our decision-making process, and act quickly and thoroughly to be able to be a supporting partner, in the deals in which we want to engage. The fact that our funds operate individually in terms of evaluating deals doesn't preclude us from sharing the deals across the AVG, sibling funds. And in fact, our capacity to find connections to multiple AVG funds and bring capital from multiple funds to bear into a single transaction gives us extraordinary flexibility in the size of the check that we write. Also reinforcing the value that we have as a partner to that lead investor and to the portfolio company. So let's take a look at the list of names with whom we have consistently, co-invested. And of course, these also, you certainly don't need me to read them to you, but I wanted to just highlight, again, back to that point about having a product at AVG that is different and better, smarter and simpler than what we could do in our individual capacity. Even if we had the resources to get into the billion-dollar, Fund 13 that one of these lead successful top performing VCs is currently raising and then deploying, if we weren't in the fund before that, in Fund 12, well, we're probably not going to get into Fund 13. So our model of working with these VCs at the individual portfolio company level gives all of our accredited investor customers the opportunity to co-invest with these VCs when they really might not even be able to do it at all, in their individual capacity. I think another important thing to note is that our database, our analytics, don't stop at the VC level, not at the firm level. We're actually digging in and looking at who are the lead investing partners in these firms and how successful are they, so that as they spin off and create new funds and raise capital from other places and begin to build their own portfolios, that we know which ones, to follow in behind. So we're able to be a very continuously active, partner for not only the firm overall, but the lead investors in these firms, even as their careers and their expertise, creates more opportunities for them to be, more engaged in this industry. So although we stay always as a co-investor, we're very dynamic in our ability to manage the relationships with the lead investors, both firms and individuals that we want to follow in behind in the deals in which we're participating for our, the benefit of our customers. So we go to the next page. This is the chart that I referenced a little bit earlier. Why does it matter if there's so many extraordinary companies and there's so many extraordinary opportunities? Maybe you might be asking yourself, why does it matter to be really co-investing with these strong, long tenured lead investors? Well, this chart really says it all. The left bar in each time period reflects the performance, the rate of return for the top quartile venture capital firms, in operation in each of those periods. And as you see, it is virtually always substantial incremental value that's being generated for the people who can be who can be investing alongside those top quartile investors. So it matters that our networked, our connected capital construct gives us continuous access to deals being led by these lead investors. So now let's flip over to the other ways on the next slide, Luis, the other ways in which people engage with AVG beyond investing with us. Everyone, I mentioned earlier, this community of 300,000 people who subscribe to our newsletters and are engaged by what we're reporting about the entrepreneurial activity of the communities of which they themselves are a part. Whether they're not ready to invest, whether they're not yet accredited investors, whether they're overcommitted, to venture capital, they're finding value in the information that we're sharing. And we, in turn, find value from their individual areas of expertise. Our expert community is open to anybody who's part of the AVG community, whether they're an investor or not. And it's an opportunity for the people in our community to document in one place their own individual areas of expertise, the place where they might provide value to one of our deal teams, looking at a very perhaps unique portion of, a unique application within a given sector, as well as to provide support for our portfolio companies. And as is noted in this last bullet, at AVG, we are very, uniquely positioned to provide connections for portfolio companies to the various experts, the various channels, the various markets that are represented by that 300,000 person community. And we do that both programmatically, where we have periodic meetings with the founders of the companies in our portfolio and ask them what's going on, where our community might bring value. And we also do it on an ad hoc basis, so that when a particular or unique circumstance arises, that the portfolio company is comfortable coming to us, and we have the resources and people internally to do the data analytics and do the digging into our expert community and make the connections that are rewarding, not just for the founder, not just for the lead investor and ourselves as investors, but also for our community members, who then get a little bit of that hands-on opportunity to really support the growth of these exciting companies in which we've made investments. So let's turn to page 13. We're going to flip right by page 12, which is just the name of our primary open access fund, the Select Fund. So I mentioned repeatedly this notion of alumni connectedness, and funds like Chestnut Street, the fund that I was the managing partner for at its inception, that are really supporting community building, deal sourcing, and analytics within a given alumni community. But in the United States, where there are 13 million accredited investors, 11 million of whom have never made or had access to venture capital, our AVG Select Fund is the place where those investors who are not connected to one of our current alumni fund schools start. Because and the Select Fund was just introduced, in 2018, and it has now been up and running and investing actively, for the last 4 quarters. And let's talk about that a little more fully on page 14. So the Select Fund, which is, I feel the same way, Luis. I kind of wanted to talk about slide 15 before slide 14. Do you think we could do that? Go to 15 first? All right, or one back. All right, let's, there we go. All right, our core alumni funds all operate in the same style and the same, use the same operational execution to build the portfolios that I mentioned earlier. And it starts actually on the far right with the notion of our investment teams. And I've highlighted a moment ago about the folks that work in the AVG environment as an investment team professional, whether they're in one of the regional offices or they're in our headquarters location. But they are all deeply experienced in venture investing, and they have extraordinary analytic and relationship building skills that we draw on to keep the deal sourcing community tight. They use their expertise to go through a process that leverages the diligence of the lead investor of the deal they've identified, and then gives them the room and time to do their own research around the team and the market and the structure of the deal in which we're contemplating, being a part. And after their deal doing process is complete, they have a decision, invest or not invest. So now if we look at the left column, any deal that is invested in by one of these alumni funds following the same analysis practice as any one of their other sibling funds, then becomes eligible to be included in the select fund. So quickly, I'm certain everyone on the phone can understand that if the investment teams are all building portfolios that have diversification by industry, stage, and geography, this significant pool, almost 200 transactions just in 2018 as an example, is also similarly diversified by stage, industry, and geography. But the middle column here, the programmatic selection, is really where the select fund is differentiated from our other funds, because understanding that every deal that is now potentially eligible for inclusion in the select fund has passed the financial projections, the venture-backed returns likelihood of our investment teams. So it's ready, we're ready, willing, and able to invest in that company. And the select fund algorithm then looks to ask itself, all right, do I want to co-invest with one of my alumni sibling funds in this particular deal? Because if I do invest in it, I'll be building a portfolio that is diversified by industry, stage, and geography for the people who've invested. Won't necessarily be a deal that comes from their particular alma mater, but will come from these strong, continuously outperforming communities of the 14 alumni funds, and will provide obviously the same value intended for the alumni fund investor for the select fund investor, with one additional tweak. And that tweak, which is, let's see, what bullet is that? The middle bullet, is that we expressly build into that algorithm targets for sector, stage, and geography, so that the select fund ends up being effectively indexed to the whole venture capital industry in the previous year. So we're able in 2019 to look at the full $108 billion deployed in venture capital in the US, the full 4,900 deals, that 4,950-ish deals that were funded, and we're able to identify 85% of the capital went to late stage deals, but 85% of the deals were early stage. That distribution informs the target distribution for the select fund. Certain industries, achieve certain proportions of the total investment. 6% went to fintech, 1% went to edtech. So we're able to build a target distribution for the select fund that reflects the industry's allocation to industry, stage, and geography as a whole. And in that respect, the algorithm helps us build effectively an index-like view of venture for those who participate. So now let's go back to slide 14 and get a sense of how that actually looks. So this has actually a sample select portfolio based on one of our earliest fund earliest vintages. And this data, the sector distribution, the stage distribution, and the geography distribution, is something, again, that is the result of applying that algorithm to the incoming deal flow from all of our alumni funds. And so at a glance, just based on the colors, you can clearly see the level of diversification that's achieved. What's not immediately obvious to you as the reader or the participant is how this actually reflects the industry as a whole, but that's data that you would be able to find in your own investor portal if you were investing with us in the select fund. So now let's jump over to page 16, because we all invest in this asset class to get access to great companies before they're public. So these are just some samples of companies in which one or more of our select fund vintages have made investments. And I wanted to just highlight a couple. and highlight a couple of things about each of them. Compass, which is a real estate play, came out of our Columbia University ecosystem. Honor, an extraordinary software and system platform that is completely transforming in-home healthcare for the increasingly large elderly population, came out of the Yale ecosystem. Jump, which was a bicycle sharing company, interesting story, I'm going to come back and tell you more about that, came out of our Harvard Fund ecosystem. Deserve, a very, very unique credit card company providing fair access to credit for underserved markets by looking at a person's potential to pay as opposed to their past payment history, came out of the Stanford ecosystem. Smart Video, a drone company that is really materially changing the safety and capacity of the construction industry, came out of the MIT ecosystem. So just to give you a sense of the impact of our alumni fund reach on the construction of a select fund portfolio. I thought for a moment, particularly given the latest news, that I would just tell you a little bit more about Jump. Jump is a company in which AVG made its first investment in November of 2017. But in May of 2018, barely 6 months after we made the investment, Jump was acquired by Uber. And our investors in the Select Fund and or Yard Ventures and any of the other AVG funds that invested first received cash consideration from the the acquisition that Uber made of Jump. That cash distribution, the cash portion of that purchase price, was significantly profitable for the investors, in Jump. But what was still to come were the proceeds from the Uber shares, which were also used as part of the consideration when Uber purchased Jump. And of course, Uber has just gone public. And after the traditional lockup period for early investors, there will be additional liquidity created for the investors who had held a pro rata, interest in Jump by investing in one of, our portfolios. So this particular page, I think, highlights the diversification of industry. It indicates the diversity of our sourcing. It highlights the rapidity, and also the early nature of returns that are possible with our investment strategy of investing across stages. And I didn't highlight the various stages, but they are noted on this particular table. So you'll see a selection of early and growth stage companies. So I think on that positive note about what can happen by investing in AVG and finding value in our smart, simple access to venture, I think I'll close my remarks and let Luis take questions from those of you who are on the phone. Line up the questions, and he or I will be happy to answer them. So thank you.
Thank you, Gail. So I'll just leave it on this particular slide here as we field questions. So as you were speaking, a couple of questions have come through, and particularly the peaked interest here when you were talking about the the Jump investment, the acquisition by Uber and then the subsequent IPO. Question came in, can you talk a little bit about your investment performance as a firm?
Yeah, absolutely. First of all, I hate to start on a downer, but I want to be really realistic with everybody on the call. These are long-term investments. Our funds have a 10-year life, as is the industry standard. None of our funds have yet had their full 10-year existence. And so it's premature on many respects to talk about performance of the funds. But just like the conversation about Jump, I'm very happy to share with you, and people in our community have access to this data, which is reported quarterly, to talk about the individual investments and their status since we've invested in them. So looking at data from 12/31/18, although honestly, the newest report as of March 31st just came out literally earlier this week. I just don't have the numbers memorized, so I'm not as facile with them. But as of 12/31/18, looking at a population of over 200 investments, 70 investments made by any AVG fund since inception in 2014, 70 of them have had exits or up rounds since we've invested in them. Only 7 companies have gone out of business and discontinued operations. These two, barbells looking at the portfolio are both extraordinarily better performing than you would expect based on industry averages, which suggests that about the bottom third of your portfolio is potentially going to discontinue operations in the period of time in which you've invested in it. And often you learn that in the first 3 years, given what's referred to as the J curve, the expected performance of growth and value creation in venture capital. At the upper end of the ranges, you're expecting maybe 2 to 5% of your investments to actually return so much capital that the fund is fully recovered by just the performance of that small subset of companies. And an equally small subset turn out to be the extraordinary winners and really create those extraordinary returns that were highlighted on that earlier page. So too short of a time period to give you AVG performance data, but if you look at our individual individual investments, and after holding them an average of only 18 months across that period of time since inception, we're looking at really exceptional evidence that our strategy of diversifying across stages and industries produces earlier and sizable returns with presumably less risk as measured by our experience with companies having gone out of business in this early investment period. So strong performance, but it's just data.
Okay, sounds great. So thank you, Gail. We've got another question here. The question comes from Alejandro. Thanks for the submission. The question is, does a select fund have different vintages? And do the 10 years of tenure start when an individual investor joins or at the onset of the fund?
Great questions. The select fund raises capital every calendar quarter, and closes every calendar quarter end. So in fact, this quarter, the second quarter of 2019, we are raising the 4th AVG Select vintage fund. And we have raised and closed and begun deploying 3 earlier vintages: the 3rd quarter 2018, the 4th quarter 2018, and the 1st quarter of 2019. Funds are 10 years long, and the clock starts ticking when the fund closes. So every investor in any one particular vintage has the same 10-year lifespan of the fund.
Thanks. I think this is a great question. Another one. I think a lot of people have talked about, have heard a lot of news in terms of being able to leverage their retirement accounts. Question comes is, how can I fund my investment? Is there any way to leverage my retirement accounts to fund my investment?
Yeah, a great question. What else do each of us have in our everyday life that we think of as long-term, illiquid, not accessible to me, right? Those are our retirement assets. So there are many reasons why people find it's a really great match to use retirement assets to make this type of venture capital investment. And nearly a third of investors with AVG do use their retirement assets to invest. Now, specifically, self-directed IRA type retirement investments are most easily used to make this investment. Other types of retirement accounts have different tax consequences and different rules around access and rolling over to make an investment like this. But generally speaking, self-directed IRAs make it extremely simple to invest. It does require having a retirement asset custodian that has the capacity to provide the kind of reporting and accounting record keeping that is necessary for alternative assets generally. And so you may or may not have an existing IRA custodian who has the capacity to manage your investment in something like AVG's venture capital funds. But we have a relationship with the largest provider of that service, in the United States, with great, deep integration to make setting up accounts easy and, cost effective to do that. So you may invest with IRA funds, and of course, I didn't highlight it, but you can, of course, also make a direct cash investment in our funds in your individual, or joint tenancy with your spouse. And you can use certain corporate structures like trusts and LLCs to also, make investments. And I'm going to grab some water. Excuse me.
Thank you, Gail. So if anyone has any other last questions, I think, we had a few submitted. I know that we're bumping up against almost an hour now. I want to be respectful of everyone's time. I have another question here specific to a Schwab brokerage account for this. Jeff, I can follow up with you specifically. I think that's a great question for our investor relations team that has all of the details on that. I don't have all those details offhand, but I can certainly connect with you offline on that. So with that, I want to thank everybody for joining us and submitting the questions and being engaged throughout the entire conversation. Again, here we will send a follow-up with the materials that you're seeing here. And we look forward to continue the conversation with everybody and your interests both in venture and with Alumni Ventures Group. And I want to thank Gail, our senior partner, for spending the time with us today, providing you an introduction to both venture investing, how easily it can be accessible through Alumni Ventures, and being able to field your questions. So thank you again, Gail.
You're welcome. Thank you, everybody, for joining us.
And with that, have a great rest of the day. Take care.